Parak Flexi-Cap fund has gone from being India's most favorite mutual fund to one of its most debated. Just a year ago, investors praised it for protecting capital during market correction. But today, many are asking if the fund has become too large, too conservative, and whether it has lost its edge. So, has anything really changed? Or have investors simply become impatient? In this video, we'll go beyond recent returns and social media opinions to understand how the fund actually works, where it excels, where its limitations are, and whether it still deserves a place in your portfolio. This is a longer video because you can't judge a 1.6 lakh crore fund in a 60-second reel. At first glance, its recent one-year returns stand at about 1.8%, which obviously is underwhelming. However, their long-term returns are still holding up good. This often fuels headlines questioning whether the fund has lost its edge. But judging a value-oriented flexi-cap fund based on a single 12-month period is like evaluating a marathon runner by their first 100 meters. PPFA is designed for investors with a minimum time horizon of 3 to 5 years, where its investment philosophy has historically delivered strong outcomes. That's one reason why you should stop looking at trailing returns. Trailing returns provide only a snapshot between today's NAV and a single starting point in the past. If the market peaked or bottomed on that day, the results can be misleading. In the past also, you can identify periods where they have underperformed the benchmarks. And that's not concerning at all. Given their value-based strategy, they will underperform the markets during oversold markets, which happens every once in 3 or 4 years. Rolling returns eliminate this bias by measuring performance across investment periods. As you can see, the average rolling returns of this fund continues to be superior. The rolling returns data show that PPFA has consistently outperformed both its benchmark and the flexi-cap category over all time investment horizons. Look at the 3-year rolling returns. The fund outperformed the index 100% of the time, highlighting the consistency of its long-term performance rather than dependence on favorable market timing. One of PPFA's greatest strength is its ability to participate in the rising markets while protecting capital during market declines. During the bull market between September 2023 and 2024, PPFA delivered 41.73% returns, while the benchmark returned just 38.82%. During the subsequent correction from September till March 2025, PPFA declined only by 7.56%, whereas Nifty 500 dropped by 18%. That's a downside protection of about 10.57% or outperformance of 10.5% during that period. This illustrates an important characteristic of the fund. It doesn't merely seek returns, it seeks better risk-adjusted returns. It's only from the bottom of that correction in March till date that they have underperformed. But when you zoom out, you see that they have not only beaten the index but also have been less volatile. So their risk-adjusted returns are incredibly superior. Now that's a great segue to volatility measured through standard deviation. Risk management has always been central to PPFA's investment approach. Its standard deviation of 9.9% is significantly lower than both the benchmark as well as the category average, which stands at about 15%. Lower volatility means investors experience relatively smoother portfolio movements without sacrificing long-term wealth creation. This is one of the key reasons why many long-term investors remain invested through market cycles. Many exit when they see portfolios fall drastically. The last metric I would like to evaluate this fund on is valuation discipline. Unlike many equity funds that aggressively chase expensive growth stocks during bull market, PPFA has straight truth to value investing, and today their P ratio, price to equity ratio of their portfolio stands somewhere between 16 to 17x, substantially lower than the broader market. This reflects a disciplined value investing approach focused on buying quality businesses at reasonable valuation, avoiding speculative and high multiple companies, investing in business with sustainable cash flows and durable competitive advantages. Rather than following market excitement, fund prioritizes valuation discipline and long-term capital preservation. At its core, PPFA follows a pure value investing philosophy. Fund treats stock ownership as business ownership rather than stock-term trading. It seeks fundamentally strong companies that are temporarily mispriced by the market while maintaining patience until attractive opportunities emerge. Its cash allocation is often misunderstood. During expensive markets, holding cash is not inactivity, it is strategic capital allocation. The cash buffer enables the fund to preserve capital during overheated markets and deploy money decisively when valuations become attractive. A good example is the correction in the IT sector. Rather than participating in panic selling, PPFA used the opportunity to accumulate fundamentally strong companies such as TCS, Infosys, and HCL Tech at more attractive valuation. This perfectly captures the essence of value investing. Preserve capital when markets become irrational, deploy capital aggressively when quality businesses becomes reasonably priced. The only concern I have with the fund is its size. Parag Flexi-Cap Fund is now India's largest actively managed equity fund, managing over 1.6 lakh crore. While that's remarkable, size comes with its own set of challenges. To put that into perspective, the Nifty Small Cap 250 Index has grown by 3.5x times in the last 10 years. During the same period, PPFA's assets under management has grown by more than 14 times. As funds become this large, deploying fresh capital into small and micro cap companies becomes increasingly difficult. Even if the fund manager identifies an attractive opportunities, taking a meaningful position without impacting liquidity or ownership limits becomes challenging. As a result, the portfolio naturally gravitates towards larger companies. Having said that, the fund has still managed to selectively increase exposure to quality mid and small cap companies during the recent correction, but it's worth remembering that valuation across much of the broader market are still not particularly attractive, so caution remains warranted. At the end of the day, the real question isn't whether PPFA is a good fund, it's how you use it inside your portfolio. At Fabits, we position Parag Flexi-Cap Fund as the stability engine and not the growth engine. We rarely recommend investing through a single mutual fund because no fund can excel in every market environment. Building wealth is about constructing a basket of complementary funds, each playing a distinct role. Think of it like building a cricket team. Every player has a role, and Parag is our Virat Kohli. He anchors the innings, provides consistency, performs when conditions become difficult. That doesn't mean Virat cannot score aggressively. He certainly can. But his greatest value lies in giving the team stability when wickets are falling and pressure is at its highest. The rest of the portfolio is then built around this anchor. We complement PPFA with funds that follow different investment strategies: momentum, quality, multi-factor, and selective mid and small cap strategies. We also include funds with relatively smaller AUMs that have the flexibility to exploit opportunity in segments where a large sum fund simply cannot participate meaningfully. This combination allows us to capture growth while offsetting some of the limitation of the PPFA Flexi-Cap Fund. In today's market, stability is not a weakness, it's a comparative advantage. With elevated valuation, geopolitical uncertainty, global macro risk, having a fund that protects capital during difficult periods becomes incredibly valuable. Remember, investing isn't only about outperforming during bull markets. If your portfolio falls significantly less than the broader market during corrections, that is also meaningful outperformance. So I don't believe anything is fundamentally wrong with Parag Flexi-Cap Fund. What needs to evolve is how investors think about its role. Used as a growth fund, you may be disappointed. Used as a portfolio's anchor, it remains one of the best funds available in India.